Capital employed means long-term funds available to a business. That is equity plus debt. Avi, you have to note down this. And this can also be calculated as non-current assets of a business minus trade investments plus working capital. That is non-current assets minus non-trade investments. It is non-trade, huh? Not trade. Plus working capital is current assets minus current liabilities. So this is how we calculate, guys, capital employed. In case we do not have any information about equity and debt, from asset side also we can calculate capital employed. Tanmay, note down this debt to capital employed ratio. Tanmay, Mishika and Avi, you have to note down this, guys. CBSE students have this in their syllabus. ISC students do not have this ratio. Business and long-term funds are only equity and debt. You know that debt includes long-term borrowings, other long-term liabilities, and long-term provisions. This we have already seen under debt to equity ratio. Here, what is debt that I explained, guys? It is long-term liabilities of a business, which includes long-term borrowings, other long-term liabilities, and long-term provisions. Right? So what exactly capital employed, guys, is? It is long-term funds available to a business, whether they are coming from owners or they are coming from outsiders in form of borrowed funds or other liabilities. Now, if balance sheet of a company is made in T shape, that is in horizontal form, then broadly it can be made like this. Non-current assets and current assets. And here equity, debt, and current liabilities. And the total of both the sides would be same. Let's say it is rupees XX. Now you also know that, guys, non-current assets include long-term investments. And those long-term investments can be trade investments, can be non-trade investments. If it is Trade investment, it means it is being used for the business only, because trade investments are those which are the investments in associated companies. So when Reliance Energy makes investments in Reliance Power and makes another company, that is Reliance Power itself, then it is called trade investment. It means the investment is being used for the company only. But if Reliance Power invests in Tata Motors or in Infosys, then it is non-trade investment, because Reliance Power and Tata Motors or Infosys has no business association at all. It means that money is not being used by the business itself, by the company, that is Reliance Power itself, but it is being used by others. Okay. So that is the reason, guys, why from non-current assets we subtract non-trade investments. So capital employed is sum total of these two. Let's say it is 20, this is 30, and this is 50. Total is 100 here. And here it is 80 and 20, 100. And in this 80, we have investments of rupees 10. Long-term investments included in non-current assets are of rupees 10. So if we have to calculate capital employed, we will take equity plus debt, that is long term funds available to the business and are being used by the business, that is 20 plus 30, 50. But out of that, rupees 10 have gone out of the business because they are, if they are non trade. So in that case, we will subtract here non trade investments. So this would be 20 plus 50 minus 10, that is rupees 60. This is how we can calculate capital employed. Or the other way is we take non-current assets, from that we subtract non-trade investments, and then we add working capital. So non-current assets are 80 minus non-trade investments are 10 plus working capital, that is current assets minus current liabilities, that is 20 minus 50. So it would be how much? 70 minus 30. So yeah, 70 minus 30, that is rupees 40. This is 30, guys. 20 plus 30 minus 10 is 40. 20 plus 30, debt plus equity minus non-trade investments, 10 is 40. So this is the one way to calculate capital employed. That is by taking the information mostly from liability side, or the other way to calculate capital employed, where the most of the information we have taken from asset side. I hope you're understanding, guys. Have you understood that, guys, what I just explained? Capital employed can be calculated by taking most of the information from liability side, or it can be calculated by taking most of the information from asset side. So except current liabilities, here we have taken everything from the asset side. That is non-current assets, non-trade investments, and current assets. You know that working capital is difference of current assets minus current liabilities, which here is in negative, that is minus 30. So 70 minus 30 is 40. Have you understood this all? Mishika, Avi, Tanmay. Mansha,
Yes, sir.
Anish, have you got
Yes, sir.
this?
Yes, sir.
Okay, now in case guys in a question you do not have any specification whether the given investments are non-trade or trade, then you should always consider them as non-trade, right? Here also I need to subtract non-trade investments. Non-trade investments or trade investments are those which are done by a company or a business in its associated business only. For example, when Tata Steel invests in Tata Motors, it is trade investment. So guys, I'm done with this. Start noting this down guys from here. CBSE students have to note down everything. ISC students have to note it down from here guys. From capital employed. Capital employed is long-term funds available to a business and are in the business. Employed in the business, including associated businesses. Is all right. Sarthak done. So as our fourth type of ratio, we are done with the third type of ratio. After solvency ratio is turnover ratios. One more is there after this. They are also called guys asset management ratios. also known as activity ratios. So, guys, these ratios are used to know how well a business uses its assets. And when will a business would be said to be using well its assets? I'm asking you guys. When will you say that a business is really using very well its assets? By looking at what you will understand this. Sales, right? Not profits, because profits is a function of expense and income. So it is sales, and sales is turnover, guys. That is how will a business can convert its assets into its turnover. That is sales or revenue from operations. Right, guys? I have also shared with you, discussed with you statement of profit and loss of companies. And there the very first term that is presented as revenue from operations, that is net sales of the business for that particular year. So here the first one that you have, guys, is inventory turnover ratio. Inventory means stock. So it is ratio of turnover, and turnover here means cost of goods sold. Instead of taking sales at selling price, we take here sales at cost price. To average inventory, that is average stock maintained by it. So inventory turnover ratio is cost of revenue from operations, that is cost of goods sold upon average inventory. Cost of revenue from operations is cost of goods sold, which you all have learned in class 11th, guys, in final accounts chapter. That is the cost of those goods which you have sold in a year. How do we calculate that? Cost of revenue from operations or cost of goods sold? I'm asking, guys. It is opening stock plus net purchases plus direct expenses minus closing stock. So let's say opening stock of a business is rupees 100, means at the beginning of the accounting year, the stock lying with the business is rupees 100. Net purchases done by the business is rupees 1200. Direct expenses to purchase this stock or this goods is rupees 250, and closing stock at the end of the year is rupees 200. Right, guys? So this is 1350, means the cost, means the goods which were sold by the business during this particular year had a cost of rupees 1350, and average inventory is opening stock or opening inventory divided by, sorry, plus closing inventory divided by 2. So now with this example, it is 100 plus 200 divided by 2, that is 150. So inventory turnover ratio of this business would be 1350, that is cost of revenue from operations, divided by average inventory, that is 150. That is 9. That is 9 times, or 9 is to 1. I hope, guys, you all have understood this. Have you guys or not? It means, guys, this business, listen to me carefully, guys. It means this business on an average, at every point of time, on an average, has stock of rupees 150. Whenever you go to this business, this shop, this showroom, you will find stock of around 150 rupees. But during the year it sells stock which has cost of 1350. It means it is converting its stock 9 times into cost of revenue from operations. Whatever stock it maintains with it on daily basis, 9 times of that is sold by it during a year. I hope you're understanding, guys. Right, Mishika, Mansha, Anish, Avi, Tanmay, are you getting this?
Yes,
Yes,
sir.
sir.
Yes, sir.
Now, if another company has inventory turnover ratio as 750 divided by 150, that is 5 is to 1 or 5 times, which company is doing better? Company A or company B? I'm asking you guys. Which company is doing better? Yes, it is A because both the companies maintain the same amount of stock, yet company A is able to sell more than company B. It means this company manages its stock better than company B. I hope you have got this, guys. Or if it is like this 1350 and 75, then this would be how much? 18 is to 1 or 18 times. Which company is good, guys? B. Because they both have the same sales. Sales at cost, that is cost of goods sold or cost of revenue from operations. But company B maintains lesser stock than company A. It means even after maintaining lesser stock, company B is able to sell as much as what company A is selling. It means, guys, higher the inventory turnover ratio, better it is for every business. And so is with, guys, all the turnover ratios. The other ratios that we will see, there also the same concept applies. Higher the ratio, better it is for the business. I hope you all are understanding this. So are you all done with this? Those who are online.
Yes, sir.
Anish, have you noted down this?
Sir, 1 minute, sir.
Avi, Tanmay, have you noted down this?
Yes, sir.